Hi, this is JP Newman on Investing on Purpose on an early Monday morning to give you a real estate forecast. Welcome to Investing on Purpose. I'm JP Newman, your host, and on this show, we're here to educate and inspire you to create the maximum impact for your business and life. You're going to hear from dynamic entrepreneurs who have created outsized returns by bringing purpose into their businesses. The mission of the show is to help you integrate your business and personal goals so that you can live life to the fullest. Enjoy the show. Obviously, there is a lot of change happening right now in the marketplace. We are watching interest rates zoom up. Inflation's at its highest. Rents actually have gone up about 20% across the country in the last year. And there's certainly a lot of uncertainty in the market. And I'm just here to kind of tell you how we see it on this side. As just to remind you, that's what we do at Thrive FP Real Estate Investments. So we've seen many cycles and kind of have our own strategy as far as how we are going to be playing out this cycle. And I thought I'd share with you some maybe practical tips of how you can maybe navigate, and I actually think find some amazing deals. If you know what's going on and you know what to do with this information, you actually could make it's not an investment show, so I can't guarantee you'll make money, but I do think there'll be a lot of opportunity out there as well. First of all, let's just look at where we're at. We saw for an 11-year boom cycle of just real estate going up, 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 and up. In places like Austin, where I live here, real estate went up, 15 to 20% a year over year. So the average cost of a house, which used to average about $187,000, went to $520,000 during that period. It's obviously a lot less affordable for a lot of people, but with low interest rates, it made it that a lot of people could afford it. So what happens when you go from 3% interest rates to today, it's 7%, and the Fed is signaling there's going to be some more rate increases. So there's very good chance you're going to see home mortgages going from like 8 to 10%. So what do you do when that happens? It makes it a lot harder for people to buy. So for rentals, like myself, who owns mostly apartment buildings, you're actually seeing occupancy at like full. Basically, all my buildings are full right now because it's unfortunate, but people cannot move. They cannot buy their house right now because of the prices and the mortgage rates going so high. So they call that kind of renters, they're basically renters not by choice. They kind of have to stay there right now. And as the market's been so tight, you're not seeing people moving as much. They're just like, and after COVID, they just kind of are staying put. So we're not seeing the same, like in Texas, about 50% of an apartment building would turn every year. And you're just not seeing that right now. People are staying longer, they're staying put. Still a lot of rental pressure because of supply and demand, because because you have these renters that are kind of locked in by necessity. Higher markets, higher rents, less movement, which is keeping rents strong. A lot of pressure out there for people, which I have a lot of compassion for because rents have gone up. But what a lot of people don't understand from the ownership side is, remember, with inflation, my janitor, that's an average, maintenance guy on a property used to be $50,000. Now it's $70,000. Managers, property tax, insurance. So we're also feeling the inflation. So it's not just that the market's increasing. It is partly supply and demand, but it's also we're seeing real cost increases on everything on our side too. So ironically, the market's strong, but our margins really are not any better than they were before because of all this inflation. What does this mean potentially for you, depending on where you're at? These are cycles. And we've been saying for years here at Thrive, this cycle has been a great cycle, but the cycle will end, and it's supposed to. You don't want it to be that prices go up 15% every year. You want people to be able to afford houses and afford things. That's the American dream. After World War II, which is a whole other story, the federal government, literally, its dream was that the average American would be able to afford a house. And it's become unaffordable. The good news, I believe, is that cycle is about to reset. And what does that mean for you? So right now, what we're seeing right now, I call this the 6 months. You always have this period of what I call buyer expectations and seller expectations. So right now, sellers are still saying, well, my property was worth X. My property was worth $1 million. My house was worth $1 million just 3 months ago. It can't be worth that much less. And the buyer is saying, well, I don't want to buy it now. I'm nervous. Interest rates are much higher. I can't even afford it. I don't think it's worth $1 million. And they call this usually a typical cycle. It takes 6 to 12 months for buyers and sellers to get their reality in basically in alignment. I call this time kind of a dissonance time. So sellers and buyers' expectations, they're in dissonance. They have different expectations because it's human nature to deny the fact that your property is worth less. How much do I believe it's worth less today? I think from what I'm seeing out there in both apartments, commercial real estate, and in homes, depending on where you're at, I actually think you're probably at about a 15 to 35% discount on real estate. Now, no one's going to tell you that because the brokers, the sellers, nobody wants to sell because, again, they're in denial. But if you actually look at what's trading right now, I think you're looking at 15 to 35%, depending on the market. In hot markets like Austin, I think it's 15 to 20%. I can tell you from my own experience because I just sold a building last week. And I was just got an offer that was $10 million less than an offer I got 3 months ago. And so I'm in the same situation. Like, do I want to sell it or I just want to keep it? Because having a price tag of $10 million less in 90 days is pretty hard for a human being to swallow, but that is just reality. And it makes sense if you do the math. Your payments are so much higher that you can only afford to pay so much, and you're only going to get so much in rent. So it actually, the math makes sense whether we human beings like it or not. So what I would say to you right now, and I've been saying to my friends, like, what do I do? What do I do? I don't think you should invest, at least from my perspective, I don't think you should invest in real estate at the current moment, but I think it's going to quickly change. What I've been telling most of my investors is keep your powder dry. Right now, treasuries are paying 4.5%. We have a debt fund. I love debt right now. Our fund's paying about 8% right now, the Thrive Lending Fund. So I like the idea of treasuries, bank accounts, lending funds on debt, and staying in debt until this dissonance between buyers and sellers comes together. And it's coming. Again, it's 6 to 12 months just from this time. And we're in November right now. So count 6 months from November. And you're talking about first or second quarter 2023. Here's what's going to happen. And here's where you could really have fun and take advantage of this is finally, when sellers get a little pressure, and when the pressure is going to come from them, particularly if they have loans coming due, because that loan that's going to come due, and this happened a lot in commercial and apartments, people were taking these like teaser loans that were a 2-year term and it had a floating rate. And so if you're on a floating rate and you're used to paying 3 and now you're paying 8, you pretty much have to sell because the lender is not going to let you refinance, or the lender's going to say you can refinance, but your property's worth a lot less because of these new interest rates. So you got to come up with money out of your pocket in order to keep this deal. And a lot of people aren't going to have money, millions of dollars on commercial. On a home, it might be a little bit different. But the point is, these people who thought they were doing great are going to realize that their property's gone down in value. And now the bank wants millions of dollars in this case to make it right. So they're going to be forced to sell at a discount. And finally, the sellers are going to have enough pressure that the reality check of what values are worth will come into place. What kind of discount? If I'm telling you we're at 15 to 35% now, the answer is we're going to find out, because if the Fed keeps doing these interest rate bumps, you're going to see bigger and bigger discounts. It's just math. It really is nothing. And so I think, I think the Fed will start to destroy the market, and it's happened before. So it's certainly, I hope they don't, but it's a possibility that values could go way down. In some markets, you might see 40, 50%. Again, I think in better markets, which I would suggest tighter markets in the South and Southwest, Nashville, Austin, Dallas, San Antonio, I think in these better markets, you're going to see it being tighter. Again, I think you'll see 15 to 25% on select assets. So what I would say for you is if rents are staying high and strong because of this renter by necessity and prices are coming down, you know what that means for you? Opportunity. And what it means for me is opportunity as well. So from a Thrive perspective, buying apartment buildings, we think there's going to be a great opportunity in 2023, 2024 to buy assets where you're going to have strong rents and lower prices and finally get back to some of the profit margins that we've not been able to do for several years. So actually, it's really just the cycle cleaning itself up and righting itself. It's a really healthy version of capitalism, even though it scares the daylights out of most people. But as Warren Buffett says, you always know you want to buy when people are freaked out. And I would say the same thing. Right when the market looks like it's in total distress, right when it looks like the sky is falling, that is a great time to buy. And I would say even, as early as now, but I would wait because I think it's going to get a little cheaper. But you might find an opportunity early. I'd start looking. And my advice to you would be, whether you're looking for a rental home or real estate, is really know your submarket that you want to be in. So pick your investment thesis on a submarket that you love. really get to know the brokers and watch the prices, because not much is trading right now because of this denial. But soon things will be trading, and you'll know when the right moment is to be trading, because when you see more trades, that means sellers finally have the pressure to sell, and you'll know to strike, and you'll know exactly what you want. So right now, you really could be getting your thesis done in terms of what areas you want to buy. And if you buy a rental home, I would say to you that there's a reasonable chance that you could buy a home either for yourself and rent the back out, or just buy some rental property, your first rental property, and it should positively cash flow. If you start taking the prices down and the rent up, I think you're going to see some opportunities for the first time in a long time where you can buy rental property that will actually cash flow. And guess what? If you're new to this game, it is the path to wealth. It's 1 home, 2 homes, 3 homes, and then you go to larger things or you don't. But it's a wonderful, wonderful path to get started on. Again, if you're tight on money, I would say, use your own home, and if it's got a converted garage, get some money from a renter in the back, or if you're single, you can rent out some of your bedrooms. But it's a great time to get in. Get ready to get in now, is what I would say. On the Thrive side, we, our thesis has always been, because we've been kind of expecting this for a while now. And so for us, it's like, if you didn't over leverage, so when the bank comes to you and you didn't borrow too much money, because a lot of people are being teased with so much money, the plan is, and the goal is you stay in the game. So even if the properties I own now are worth less, because I own good properties in good neighborhoods, I plan not to sell. So the whole point is you try to get yourself not in that pressure point where you have to sell. And so by not over leveraging your money, owning better assets, the plan is to keep some of these. And if you look at my last offerings, they're all 5 to 10 year kind of long-term plays on markets I love, like the ones I mentioned to you. So that's the plan. And then we plan to buy. We're actually raising money now, focusing on debt for the moment. Again, debt is great right now to be the bank. Wait, watch, and strike. And that's exactly what I'd say to you is wait, watch, and get ready to strike. It's going to be awesome. You just got to stay informed. Don't let your emotions get too far in the way, and just think it through. And the bottom line is, if you can start getting a property to cash flow, if you can see the new price with the new interest rates and still see cash flow, I'd love to see 5 to 15% cash flow. If you can get 5 to 15% a year in the money in an asset that you believe is in an area that's growing, that is just a great, 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 great pathway for you to really build a nice portfolio. And by the way, you can still invest with companies like Thrive that do it for you. So you can either be your own investor and own your own properties and change the toilets and fix up your house, or you can go to an investment group like Thrive or other groups out there and let us invest for you, where we just take care of everything A to Z. We've done this, many, many years. I can tell you historically, there isn't a major difference. Sometimes if you're really a smart investor and you really got your operations and your management, you really love to be hands-on, you can make like maybe 2% more than you could make with a investment advisor. But if you're really with the right investment advisor, someone that you think is really sharp, I can tell you historically, there isn't a huge difference. So part of it is just your own style of what do you like better? Do you like being hands-on? Does it feel good? Do you just want to own some of your own assets? Nothing wrong with that. I think it's great. Or you know what? I got my own life. I'm an entrepreneur. I'm busy. I'm a dad. I'm this, I'm that. I really just show me the statement and make me some money. And most importantly, I always say, because nobody can guarantee that they can make you money, but I always say, do you believe that the group that you've chosen, do they have a great track record? Are they competent? Are they trustworthy? And if you think that they've got a great track record, and you need to find this out, you need to ask anyone you go to for their track record, because the competence will show up in their track record. As you do references, definitely ask for other investor references for the trustworthiness. And then you ask questions like, have you been sued by an investor? What was the lawsuit over? Like just all these different things that you might want to ask just to do your diligence to make sure you're with the right group. That's it for now, guys. Really, really exciting time. Scary times are exciting times. I am excited personally for what we're doing here at Thrive. I am excited for you. And if I can be of any help, feel free to reach out at investingonpurpose@gmail.com. And I'd be happy to answer any questions. Hope you're well, stay strong, and happy hunting.